Welcome to Dun Bradstreet's 5-minute briefings. I'm John Payne, Senior UK Economist in the Country Insight Group. In this briefing, I will be breaking down the key takeaways from the UK's autumn budget and what they mean for businesses and investors. Wednesday, the 26th of November, brought to an end months of speculation on the direction of travel for the UK economy. It would be fair to say that the economy has been a bit stuck since March, following the mini-budget that undermined confidence in the government and global developments have thrown business planning out of the window. It had been known for a while that tax increases were going to be on the cards, with a wide range of rumoured policies, such as increasing the rate of income tax, additional taxes for businesses, and wealth taxes. The outcome was less dramatic, with some increases in tax being used to increase spending and give the government more wiggle room to adapt to global events. With the tax burden increasing, I will summarise what this means for the UK economy and how you can adapt your business strategy. Next year, we will see a significant increase in government spending to provide more funding to the NHS, increase defence spending, and unlocking investments in key target areas such as housing and transport. As a result, the budget also included an increase in taxes of £26 billion. However, the majority of it is coming at the end of their time in Parliament, with less than £1 billion of tax increases scheduled for next year. So what measures have been announced to achieve this? Overall, the cost of last year's autumn budget mostly fell on businesses. This year has proven to be the opposite, with households feeling the pinch over the coming years. This will add uncertainty at a time when the labour market is already strained. Many people are out of work and looking for work, while the pool of job opportunities is shrinking. One of the bigger changes announced was an extension of the freeze on income tax thresholds. These are somewhat of an easy win to get around fiscal rules, as it drags people into higher rate bands quicker as their pay goes up. But it does not immediately impact individuals' pay packets. Over time, though, this will prolong the handbrake on the economy, as people's disposable income does not rise as fast. Certain households have been targeted further, with higher national insurance contributions for landlords and a new council tax surcharge on high-value properties. We view the changes to the pension salary sacrifice scheme as potentially the most impactful for many. Starting in 2029, worker contributions will be capped at £2,000 per year. Companies with more generous schemes will end up paying more, and the impact could be passed on in the form of lower contributions, lower wages, and/or lower bonuses. This will disproportionately impact people making big contributions to get around the cliff edges at tax thresholds. And this also creates a long-term risk for the financial position of many households, given generally low savings rates. To offset some of this impact for households, the national living wage and the national minimum wage have been increased, along with removing the two-child benefit cap. As mentioned, businesses got off lighter this time around, with some sector-specific taxes and increases in some business rates. Outside of the budget, the pending Employment Rights Bill will likely create additional costs and administrative burdens for businesses in hiring, adding on to the costs from last year. Positively, energy discounts are set to come in for the most energy-intensive companies, which should help to bring down the cost of goods across the UK supply chain. Financial markets responded positively in the aftermath of the budget, with the yield demanded by investors to buy government debt falling and the pound increasing. This reaction does require monitoring, as backloading the pain in this way raises questions over how realistic it is, particularly as most of this pain will come in the run-up to the next general election, where spending cuts will be hard to justify. We had been looking for a slightly more deflationary budget, with more upfront measures aimed at taking some demand out of the economy. In its current form, the budget should still help inflation fall more quickly into next year, and therefore we expect the Bank of England to be able to move more aggressively and cut interest rates several times over the coming 18 months. All of this should bring the economy onto a more stable footing to allow for the more structural reforms proposed, such as support for high growth sectors in the industrial strategy, lowering energy costs for 7,000 businesses, and approving the Planning and Infrastructure Bill. What does this look like in terms of the numbers? Well, with confidence low and financial conditions tight, we expect the economy to get off to a slow start in 2026. But we are now likely past the peak of inflation, with many of the price increases from things such as utility bills last year dropping out of the calculation. With lower borrowing costs, the back end of 2026 and into 2027 should see some more comprehensive growth. And this could not come at a better time for businesses. Here at Dun Bradstreet, we conduct a survey of businesses across the globe to get a sense of how optimistic they are feeling. This chart shows the results for the G7 countries. And as you can see, optimism among UK businesses heading into the final stretch of the year fell to its lowest level in almost 2 years. The decline in the final quarter was particularly sharp, with the budget looming. A large proportion of businesses surveyed were expecting higher corporate income tax rates or further spending cuts. So, as we have seen, many of these worst fears did not materialize, and therefore it could provide the shot in the arm to many businesses that had been expecting the worst. The hope is that this is the last big tax-raising budget of this parliament. By also committing to just one fiscal event per year, these changes are a positive step towards reducing uncertainty and giving businesses and households the confidence to get spending again. As we move through 2026, it will be important to ensure employment costs remain contained and utilize the support out there for your industry. With lower inflation, borrowing costs should fall, creating an opportunity to explore new capital expenditure projects. To summarize, the budget didn't raise taxes as much as people feared, but neither did it spook financial markets with unfunded plans. We now expect the economy to start 2026 slowly before picking up into the second half of Labour's time in government. Thank you all for listening, and if you have any questions or would like to understand more about how Dun & Bradstreet can help accelerate your strategy, please get in touch.